Hello and welcome to Inside Out, a show where we focus on individual stocks with in-depth analysis, deep dive into financials, and we also tell you about the key risk and triggers going forward, Sonal.
Hi, Nigel. Not only that, we'll also put spotlight on the key metrics that Nigel just mentioned. We'll also ask the questions that you want to ask. So, Nigel, we are not wasting any time. What is the stock on our deep dive today?
Well, the stock that we're focusing on is SBI Card, and the stock is on my radar. Remember, they came out with their IPO at the onset of the pandemic. Well, in terms of the total quantum that they raised was around 10,000 crores approximately. Bulk of it was taken away by SBI and Carlyle Group because that was via the OFS route. But the remaining 500 crores, well, it flew back into the company. It had a tepid listing, by the way. Obviously, the timing wasn't great, so that's why, in fact, it did see a tepid listing. But the stock recovered from the low point of the day. But as we speak, it's back to the 52-week lows.
Okay, so Nigel, break up the digital payments ecosystem for us. You know, I use UPI. I see a lot of millennials using UPI. So how does credit card fit in this scenario then?
Well, that's correct, Sonal. You know, UPI usage as a percentage of the total digital payments ecosystem, well, that's expected to surge up in the coming years. But the pie itself is likely to grow, which means that in absolute terms, the credit cards, well, they could continue prosper as per Edelweiss's report. Remember, UPI, well, it deals with payments from one person to another, while credit card deals from one person to a merchant. That's P2M. Additionally, the ticket size of UPI, well, it's relatively lower in comparison to credit cards. That's indicating limited cannibalization that could possibly take place. Edelweiss, well, they're reasonably optimistic on the credit card prospects. As they state, there is tremendous penetration potential here in India. Credit lines in offer are still valued significantly by customers, and they have also highlighted the fact that UPI apps, they're now supporting credit cards. So those are the factors at play.
Well, Nigel, I can't reveal which credit card I use, but I would definitely like to know how does the market share shape up for all these companies and what parameters are used here?
Okay, all right. You know, there are two parameters basically that the market share is based on. One is on spends. The second factor is the number of cards. Remember the leader, that's HDFC Bank, that was under embargo for a few months. But it was ICICI Bank that went ahead and seized the opportunity. While SBI Card, well, they only managed to hold on to their ground. Well, Sonal, I would say that's a disappointment because they had the opportunity, but they didn't go ahead and grab market share.
Okay, so let's put this across to the management, right? We have a fair idea of what the company does. So let's get in the management and understand more about their plans. We have the company's MD and CEO, Mr. Rama Mohan Rao Amara, joining us now on the show. Mr. Rao, thank you so much for speaking to us and welcome to the show. So I want to begin by asking you this question. The largest player was under embargo, but it seems that ICICI gained market share, but SBI actually lost an opportunity here. Explain what happened.
At SBI Card, our sourcing strategy is not aligned to competition. We have our internal strategy where we look at the customer segments, what we want to cater to, whether we understand them sufficiently in terms of their bureau records, in terms of their digital footprint, and then figure out the right channels and right partnerships to leverage to acquire the customers. We have diversified channels to acquire the customers, both banca channel where we have access to the SBI customer base and open market, which has given us the right volumes. Last 6 months, we clocked more than 300,000 new accounts. And December quarter, we clocked more than 1 million new accounts, which demonstrates the resilience in our model.
Okay, thanks for that clarification, Mr. Rao. But Nigel, let me come across to you first. I believe that customer base is also segregated into various buckets. So explain that to us.
Well, through that, Sonal, and let me explain that to you as well as all our viewers. Well, it's divided into various segments. One is a revolver. He uses the credit card who pays off his balances over time, while the opposite of revolver is a transactor. They pay their credit card balances each month. They avoid any kind of interest charges. Well, Sona, let me make it simple. In simple terms, revolver would be Nigel as a bachelor. He pays off his bills at ease, coughing up interests as well. While today, I'm the transactor category. I use the credit card simply as a transaction tool. The other category is EMI, which converts the purchase into EMI at the time of purchase. But they pay interest rates which are a little bit lower than what the revolver pays, if at all any interest payment that is. The smaller segment is the one allowed under the RBI's restructuring scheme, which will be gradually phased out.
How times change, right? From revolver to transactor. That's what you've been saying.
I don't know how it happens, Sonal, but yeah, that's life, I would say.
Okay, then let's move on and take this question to Mr. Rao. So what is the ideal receivables mix that you're looking at? Revolver segment has declined from 34% to 27%. How much should revolver contribute since it's the most lucrative in terms of earnings for you?
we were at 34% in a steady state scenario. I'm talking about a pre-COVID kind of period. Afterwards, we have seen certain segment of customers from self-employed category and the Cat C kind of customers opting for moratorium during the distress period, and then also opting for a hardship tool, where around 9% of the portfolio got restructured. And largely it is by converting the revolvers into a kind of EMI loans with a tenor, a maximum tenor of around 24 months. And so this segment, they got definitely impacted, and now they started paying. Some of the RBRE portfolio we have recovered already, and some of it became delinquent and we have charged off. But simultaneously, as and when the things are opening up, we have recalibrated our risk appetite. We are permitting again a new set of customers based on the learnings in the pandemic. We have fine-tuned the models. We are permitting and opening up and increasing our risk appetite. Yes, as of now, as at the end of December, revolvers account for 27%, but we would like it to go, and we are confident that it will increase over a period of time. As you rightly said, when the revolvers increase, it increases the yield on the portfolio, and all the metrics will further improve.
All right, Mr. Rao, but give us a sense in terms of the ideal mix. Where does revolver go from around that 27% odd? Go ahead.
We would like it to reach the steady state scenario of 33%, 33%, 33%. But it depends on, it may take time. It will take a few quarters time before it reaches that.
Okay, Nigel, let's talk about the financials now. What is the revenue stream here, and what are the key ratios that one should look at?
Okay, there are two revenue verticals basically. One is the interest income, which will be paid by the revolvers and the EMI part of their business, while the transactor, like me, will only be contributing to the fee income. Now, credit costs, well, they have gradually been moving up to double digits, but the street will be waiting by for normalization of these credit costs. The ROA and ROE as well are up for you on the screen. And what is encouraging is, even in difficult times, well, the ROE, it's held at high teens. So that's a positive.
Okay. So let me take this question to Mr. Rao now. Credit cost has shot up for you from 9 to 10%. When does it get back to normal levels and then trend down as well?
Last few quarters, if you see, credit costs started actually coming down. Yes, the degree is not very much to be seen, but actually it started coming down, particularly the last quarter is a notch lower than the previous quarter. But if you look at the stress book, the RBRE only accounts for just 2% of the overall assets from a maximum peak of around 9% in September 2020. So, and even this 2% portfolio also, 70% of the portfolio is less than 30-day DPD, so they have been paying well. And whatever stress is there in the remaining part of the 2%, we have already provided for, and it has been duly recognized. And also taking into account the fact that wave 3 is not as severe as previous waves, with the collection efficiency being almost intact, we are very confident that the credit cost will further come down in the Q4.
Okay, we take that on board, Mr. Rao, but we're looking for a couple of numbers. What is the credit cost guidance from here on? Go ahead.
Yeah, I think numbers, it will be difficult for me, but I can give you two things. Like a BAU, what we call business as usual portfolio, is trending similar to the pre-COVID scenario of 5.5 to 6% kind. And that accounts for 98% of the portfolio. And only 2% of portfolio is there at restructured. So some part of it obviously will have to be charged off, etc. But we feel like we have duly recognized most of it. So the lag effect will be there. It is not like a straight away will become, we will reach the pre-COVID level. It will take a couple of quarters more before we reach a pre-COVID level of 6 to 6.5%.
Let me try to get some more numbers then. Give us the targeted ratios in terms of ROA, ROE and cost to income ratio that actually moved up to 60%. Where will they go from here on?
First, I will start with the cost to income ratio. Yes, I think pre-COVID scenario, we were operating in a large, in a band of around 55 to 57%. And as you said, like in December quarter, it increased to 60%. You see, like Q3 has been a busy period, particularly after second wave. We wanted to make right investments in the business in terms of acquiring new customers in a very robust way, and also clocking the spends by making the right marketing offer, which entails offering cashbacks, etc., which elevates the OPEX. And we have also seen one phenomenon where our corporate spends have also started increasing. So in corporate spends, basically whatever interchange, etc., you get, most of it is given as a pass-through. Most of it is passed on to the customer. So it increases both numerator and denominator. So slightly it has an effect of increasing the cost to income. But there is a seasonality in the cost to income. Our Q3 always demonstrates a higher cost to income, and it comes back to more reasonable level in the subsequent quarters. ROE, coming to ROE, as I said earlier, credit costs will continue to decline. Touchwood, wave 3 we talked about, like it is not as impactful as the previous wave. So any improvement over the previous quarter, reduction in the credit cost will automatically add to the ROA. And you know the leverage of the company around 4. So automatically the ROE will also be a function of improvement in the ROA.
We'll come back to you, Mr. Rao, but Nigel, give us an insight in terms of the valuations of the company, of the stock that is. And also you said it corrected, so there could be some risk associated with the stock as well, right?
Okay, all right. Valuations, well, Sonal, it trades at roughly around 30 times its forward earnings. But keep in mind, it's the only listed player in India. As per RBI regulations, it prevents banks from listing their credit card business separately. But the biggest overhang is the potential cut in MDR, that's merchant discount rate charges on credit cards. Finally, well, Carlyle, they have been reducing their stake and they're now down to around 3%. Well, that could be a bit of a selling overhang. But let's put up a couple of these questions to the management. Well, Mr. Rao, you've cut your reward points, right? Is this in anticipation of MDR cuts? If you could tell us how much you have cut your reward points as well by. Have you preempted MDR cuts and that's why you're cutting your reward points? Go ahead.
I think we constantly look at the relevance of value propositions, what we offer for various types of cards. And we benchmark it to the market, we scan the customer behavior or customer feedback. So when we look at our Simply Save card, there we realize like a customer has propensity or a kind of instant gratification they derive more through cashbacks rather than rewards. So that prompted us to make slight tweaks to the reward structure. This is nothing to do with impending MDR cut or anything because we don't even know because RBI is yet to come out with a discussion paper on MDR. So this exercise we do internally at regular intervals. It is like a constantly evaluating the feedback received from the customers and then the industry and then making tweaks to the value proposition which makes sense both for the customer and the company.
Okay, Mr. Rao, the second risk now. Carlyle came to you, the market with you, as Nigel mentioned, but they have now reduced their stake. Any news from Carlyle Group if they want to sell out and we will see something in this regard very soon?
I can't comment on their internal mechanics as to when they want to offload, etc., or at what price point they want to do. It is their internal call. We don't have any clue.
Anything.
Okay, all right. Thanks a lot for joining us, Mr. Rao. That was a deep dive into SBI Card. Nigel, thank you so much for explaining this business to us.
Well, I learned it. I was happy to explain it as well. But on that note, we'll slip into a short break. On the other side, we'll be coming up with another interesting stock. A stock, in fact, that's been in focus. GAIL is going to be the stock in our Spotlight segment. You don't go anywhere.